It's wonderful to have you join us here for I think it's the penultimate panel session of the day, and it's an absolute pleasure to introduce James English, partner at BCLP, David Rinder, principal, Areas Management Corporation, and Case Maknojia, investment and commercial manager, alternative fuels at Pilot Company. So brilliant to have you join us. So I'm going to, if it's all right with you, dive straight into the questions, okay? And we're thinking about the investment in the rapid charge of public infrastructure in North America. And of course, we know how essential this absolutely is to instill that consumer confidence, amongst other things, to help people overcome their concerns and make the switch to electric mobility. So first question then to you, James, if I may. So what strategies can address the legal challenges of expanding infrastructure along highway corridors that are controlled by single entities? And by single entities, I mean things like toll roads.
Yeah, so I've been lucky to negotiate a few deals on behalf of the toll road entities, Pennsylvania Turnpike and the Indiana Toll Road in particular. And the challenge there is, you have companies, like Pilot, for instance, that, have aspirations for a network that expands across essentially all corridors. But on those corridors, essentially the entire turnpike or the entire toll road is owned by a single entity. So what the companies have to do from a legal perspective is to engage with those entities to get concession agreements or broad scale installation agreements where they basically provide the service to the entity over a long-term period, and they also have to negotiate those with the assumption that it's not like a real estate lease or license type model. These are sophisticated government entities that will probably accept nothing less than essentially strong commitments for capital expenditures, strong commitments for installation timelines, et cetera. And we were fortunate enough to end up signing a deal with Apple Green Electric in Pennsylvania, and the same has also been done in New York, and then Indiana has taken a little bit of a different approach. They did a procurement to a wide number of entities, but the way the companies have to approach it is assume sophistication and assume more commitment is required than the typical real estate type solution.
Thank you, James. Does anybody else have any thoughts on that before we move on? No? All good? So, and I should have said as well, Trent Murphey from Bain and Company was due to join us, but sadly his flight was cancelled, so he's not here today. So, David then, so what level of market maturity is needed, and are there insurance mechanisms available to attract investment to accelerate the rollout of public charging infrastructure?
Yeah, absolutely. So maybe quick 20-second intro. I'm Dave Rinder, I'm a principal at Areas Management. We're an alternative asset manager, about $450 billion under management across a variety of different strategies. Where I sit is within our infrastructure opportunities team. And so we're a flexible capital strategy dedicated to sustainability. That includes EV charging investments. We've got one relevant portfolio company today called Current Trucking, which is more oriented towards the fleet charging segment. So they own and lease electric vehicles to commercial fleets. We also own charging infrastructure in an as-a-service model. But we've spent a lot of time thinking about public charging over the years. Unfortunately, I think this won't come as a surprise to most folks, level of market maturity, it's still quite early in the US. When we think about what are the tenets of an infrastructure investment, it's real asset downside protection, it's long useful life, it's revenue visibility. Right now, where we are in the market for public EV charging, doesn't index great along those parameters, but I think there's hope, right? I think we've spent some time thinking about Europe, and I would say Europe in terms of levels of adoption is probably around 5 or so years ahead of the US. There are some fundamental reasons why, public charging, is ahead of the US right now in Europe, but I think we'll get there. I think what it's going to take is a more robust historical data set to be able to more accurately forecast utilization and charging margin, right? For an infrastructure investor, that revenue visibility piece is right now what's lacking, and I think we'll have more robust data points as the market matures over time. With respect to insurance, we haven't seen it yet. We've seen some states work on, I would say, incentivized insurance programs, so providing some sort of utilization backstop for public charging. I would say I'm not sure that we'll see the commercial insurance market get there. Right now, it's very good for insuring against long-tail casualty events, but I think utilization and charging margin is more of an equity risk right now, and the market will get there. It's just a matter of time.
Thanks very much, David. And I'm just going to stay with you for a moment, and I think this is probably linked a little bit to what you've just been talking about, but how should, as an investor, how should that investor approach the balance between those short-term costs and the long-term returns in EV infrastructure projects?
Yeah, I think it's, I think right now it requires a more strategic long-term view, and it's going to be primarily equity funded out of the gate. But I think if investors can acknowledge that sites have strategic value because they have access to adequate interconnection capacity, there's proximity to highway infrastructure, there's appropriate and attractive amenities on a site, I think what's important is that you have long-term site control to be able to tap into the back end of that utilization curve, which I think we all expect will continue to escalate exponentially. It's a matter of time before that happens, but it's acknowledging that you may need to support a site in the early years until you get to that more attractive back end of the curve.
Yeah, thank you very much, David. And I think in the UK, certainly, we're seeing that policy decisions can really impact investor confidence on the public charging infrastructure side as well. So once that starts to turn around more positively and favourably towards EV, then investor confidence can increase quite dramatically, we hope.
Yeah, and I would say we've seen in Europe, there's project finance debt markets that are accessible for EV charging assets, and what is a prerequisite is scale, diversity, ideally sponsorship, and the bank markets can be there.
Brilliant. Thank you, David. Case, to you then now. So how does Pilot's project with GM address investment in both urban and rural infrastructure needs? And from that project with GM, what scalable solutions have you seen emerge?
Yeah. So Pilot and GM are collaborating to build up to 500 EV charging stations across the US. Now, those charging stations will be equipped with at least 2 fast chargers. So these are level 3, 350 kilowatt hour plus chargers at each of those locations. One of the things that we've seen from a geographic lens, to answer one of the questions earlier, has been it's a coast-to-coast network that we're planning on building. And fortunately for Pilot, our locations are in key strategic transportation corridors, right? Not necessarily in urban centers, but actually between urban centers and the routes from city to city. And so that's a great advantage that Pilot has that we're leveraging to build out and bring range comfort, maybe not range anxiety, since that's been alleviated, range comfort to the EV drivers as they go on long road trips, city to city, state to state.
That's brilliant, Case. And yeah, I love that term, range comfort. I might borrow that, actually. Again, and I think, again, just thinking about what's going on in the UK, to do a little bit of knowledge transfer or sharing, then we seem to have moved from range anxiety to charge anxiety, because it is just so important that those charges work, they're easy to operate, and et cetera, as we all know. James, in your opinion, how can public-private partnerships create a more liquid market for EV tax credits?
Yeah, so I'll make two comments on public-private partnerships. Like, they're basically in their infancy right now when it comes to EV charging and transportation infrastructure in the 3P space. Airports, for instance, would be a fantastic candidate for PPP type investments, because every single airport has a garage. Every single airport can integrate it into their model, where they're essentially conceding services to providers, but really it's not happening yet, and the real only ones that are happening are projects that are just direct concession type agreements, which are the easy models for the providers, right? Because it's essentially the concessionaire does nothing except for provide access and some property, right? And then the service provider does nearly everything. We need to evolve into models that are supported by bonding, models that are supported by public financing, where maybe that airport or the city would underwrite a portion of that, and then as to the tax credits, that can basically just be a supplement to that entire deal structure, right? Because the tax credits are essentially made to alleviate the finance risk in a lot of transactions for clean energy, and so the PPP space, and for that matter any municipal interaction with transportation infrastructure can just benefit with using some of the models we know work with other types of transportation, like trains and airports, and the concessions and fuels at the airports, and use that for the EV charging infrastructure.
Yeah, brilliant. Thank you, James. So now I'll ask this question to each of you. So it's quite a big question, but I'd really like a short answer, if that's okay, just looking at the time. So, Case, I'll come to you first. So what business model is needed for a charge point operator to establish itself as a long-term player?
I think reliability and ensuring that we're creating the best customer experience for the EV driver, right? I think we're leveraging what we have on our existing gasoline business, right? Which is trying to offer the customers a safe spot for them to come and charge. Some of the elements to that involve having canopies. So a lot of the sites that we're designing as part of the 500 stations that we're contemplating is having canopies at EV charging stations. You typically don't see those today, right? But we want to ensure that the customer has the same experience as they have had historically when filling up gasoline vehicles. In addition to that, it's about offering amenities that our pilot travel centers already have today, which is showers, clean restrooms, restaurant offerings, and a safe spot to come and fuel, right? On the charging infrastructure side, all of the charging locations that are going to be on our sites are going to be equipped with Wi-Fi capabilities, right? So the drivers can sit in, pull up their phone, not be on their network because they may be in between cities, they may not have great network for cellular reception. They can come in and connect to the Wi-Fi from the chargers directly, right? And reliability ultimately is going to drive the customer experience as well. So we're keenly focused on ensuring that that is occurring at every level of Pilot's business.
Brilliant. Thank you. Love it, Case. David, super quick.
Yeah, I think for me it's vertical integration. So, I mean, there are table stakes type scope like development and construction or maintenance to ensure reliability, but then there's also capturing additional segments of the value chain like control over amenities and earning margin from that. There's also an important energy management scope to charging, particularly doing so at scale and participating in wholesale markets, signing up renewable PPAs, for example. So I think having integrated capabilities is extremely important.
Brilliant. Thank you, David. James.
So I'm going to give a very similar answer. I think we need consolidation because, early days of these markets were essentially software companies, acting like infrastructure companies. And I think it's high time that those companies consolidate into actual infrastructure companies or vice versa, software companies consolidate into infrastructure companies, and managements take over one side or the other and run the company like, one business. And then same goes for, consolidation that achieves the vertical integration that David was talking about. I think it would be, intelligent for, some of the retail providers, some of the, mixed use real estate companies to start picking up some of these companies that are good at charging, but maybe are suffering on revenues because some of the successful, charging, charge point operators are because they've got a large business behind it that does other things. So I think the answer to how to improve business models is, decrease balkanization and consolidate the industry a little bit. So.
Great, thank you. Consolidation. Thank you, James. So we have time for maybe 2 questions if we're really quick. So hand up over there. Please say your name and the company that you're with. And if you're directing the question to a particular person.
Hi, I'm Jimmy with Zero Electric. I think my question is for David. So we see across the industry this sense that, and I think you alluded to it as well, that as adoption kind of ticks up, you're going to see utilization tick up, and that's going to make business sense long term. I have a counter argument to that, which is that these stations are built for peak, basically like the utility size for peak. And what you're going to see, and this is already happening today, is that locations on weekends and travel times, you see queues at those locations, which would drive competition, right? That's why there's gas stations across from each other everywhere you go to, which would actually change that long-term business model, right? So you wouldn't see the tick up of adoption matching utilization. How do you look at this from an investment decision point of view?
Yeah, it's a great point. Right, the consumer, the driver is conditioned to be able to pull up to a gas pump and not have to wait to fill up. And when you think about pulling up to a charger, which is already a 20, 30-minute experience, you don't want to be queuing before having to fill up. And so you're right. I think there is a cap on utilization before drivers drivers refuse to accept that as part of their experience. I do think even if we have to add chargers at that point, there's operating leverage that sites can benefit from. So a lot of the upfront expenses are around site prep or running conduit or dropping a transformer or filing for utility interconnection capacity. And so over time, as I'll call it infill sites, as you upgrade a site over time, hopefully that economic utilization point also declines over time, and you're able to, you're still able to capture additional kilowatt hours, even if maybe the percentage utilization across the full suite of chargers is a little bit lower for practical reasons.
Thanks, David. Do we have another question?
This is for David and maybe a Case, but related to what you talked about, briefly you mentioned kind of PPAs and everything and that being a key to this, but over in Europe, the company I work for, we're in Europe and work with CPOs over there. And pure play, you talked about vertical integration and that being important and integration and everything, but from the purely like the charging the kilowatt hours, some of these pure play CPOs, when they get good sites that are utilized in the 12 to 15 to 20% range, are able to make 30 cents per kilowatt hour. And that's like a pretty healthy margin. I know it's not a one-for-one comparison to gas, right? But like gas station chains are not making their money. The margins on gas is pretty low, right? And I know it's not one like-for-like comparison, but have you modeled that at all and looked at that and say, wow, if you can lock in a low PPA and you can get 20, 30, 40 cents per kilowatt hour and the utilization hits 15 to 20%, you start to really become profitable?
I can take the first stab at that. So you're right in the assumptions you're using there, right? There are definitely sites, even within the network that we have today, where we are seeing high utilization, and we have to think about, to answer one of the previous questions about future proofing, right? Margins are healthy. However, we tend to look at things from a network-wide perspective, right? We're building sites in locations that have extremely high demand charges and have extremely high just variable utility rates, right? And they have very, very low utilization. So 1 or 2 cars come at the same time, we're getting hit with the maximum kind of demand charge that we can potentially get hit with, right? So we have to look at things from a network-wide perspective of, hey, we may have one site that's really good, similar to our gasoline and diesel business, right? Not every site performs at the same level. When you're thinking about things from a network-wide perspective, you have to keep those things in mind and understand that you're going to have some winners and you're going to have some losers, right? But how do we make sure that the network overall is reliable, consistent, and priced appropriately and fairly for the consumer?
Maybe to add to that, I would say when we think about the value proposition of PPAs, it's A, securing renewable energy and ensuring that the charging is sustainable. It's B, demand charge management. It's C, energy price volatility mitigation. Sure, it's great if you can lock in a low price over term, but that starts to get into a bit more speculative consideration. So that's tougher as an investor for us to take a view around that, I would say. With respect to are there other portions of the value you're getting at around the convenience stores, for example, that's a big philosophical debate that we have around investing in public charging. There are pure play CPOs which don't have exposure to the amenities part of the value chain. Do the conventional fueling stations start to deploy chargers and accept lower margins on charging because they have the convenience store revenues as well? So it's a philosophical debate. At this point, we don't know exactly how the market's going to develop, but that is a risk for financial investors, I would say at this point, that people are thinking through.
Can I say one thing on this? So I think the charging industry needs to take some cues from the natural gas industry, because the natural gas industry, for instance, has prepaid gas purchases where they can lock in low natural gas prices for a 30-year bond period, and I'm pretty sure there's no corporate PPAs that take advantage of that model because there's been such high desire to match it with renewables, right? But there are strategies, usually corporate-wide, to use where you can lower that marginal cost of energy to your charging station.
Brilliant. Thank you so much. And with that, I shall wrap up the panel. Thank you, James. Thank you, David. Thank you so much, Case. I'll invite you to move off stage now as we prepare for our late afternoon keynote.